theoretically. They will discount all of them at a rate of R, which is the return required by the company shareholders. So to better understand dividends, we must first understand net income. Net income has two homes, right? It either goes to retained earnings, it's paid out as a dividend, or some combination of the two. So 50-50, maybe 20% retained, 80% paid out, or some combination of two. So net income has two homes. Right now, our book does not very often introduce us to detailed financial statements. All right, they're very brief, and so instead of having a full balance sheet, they just might give you the value of what they call equity, right? And so we know that this net income, if we decide to reinvest part of the earnings, are added to retained earnings, right? Okay. Now, we won't be working with two equity events at once. In other words, we won't be retaining some of our earnings and issuing new common stock at the same time. Okay, so therefore, one item at a time. Well, since a change to retained earnings is also a change to equity, then we won't see the change to retained earnings directly. We'll just simply see it as a change to equity. Okay, so the addition of retained earnings also becomes an addition to book equity. That's all we'll see. Okay? So here are some of our basic definitions. Book value per share, BVPS, includes all balance sheet equity items. So common stock, retained earnings, paid in surplus, treasury stock, and I'm sure that if some of you are accounting majors, that you would, and maybe even have already gone out for your for an audit internship or something to that effect, you know very well that there could be quite a few other items in the book equity. But we're in this class, we'll just see one number, one value, and we're going to call it book equity. Okay, so if I take that book equity value and divide it by the number of shares, I get book value per share. ROE, return on equity, this is the same definition you've commonly used. Net income divided by book equity. Or if you want, you can say it's the earnings per share divided by book value per share. That would give you your ROE, wouldn't it? Earnings per share, it's the same. It's net income divided by the number of shares. I'll use the abbreviation RE to designate retained earnings. Okay, now here's one that's a little bit new. It's called the plowback ratio, or what percent of net income is reinvested or plowed back into the company. So I remember a student had difficulty on a test because this is back, of course, when we had actual classes, and I said the company's plowback ratio is 40%. Or I'm sorry, I said the company is reinvesting 40% of its earnings. So I see someone raise a hand, I come back, and the question is, what's the plowback ratio? I need the plowback ratio to make this calculation. Okay, well, the plowback ratio is the percent of net income reinvested. So when I say a company reinvests 40% of its earnings, then it plows back 40% of its earnings. So those are the same terms. Okay, now also you can notice by the definition of ROE, earnings per share divided by book value, that gives us a way of calculating. So this here implies that, right? So we can pull from this that earnings per share is equal to book value per share times ROE. So what I'd like you to do now is let's make a copy of this this table. So I'm going to copy it, and then let's drop it into an Excel sheet. a blank Excel sheet. And I'll blow mine up so that you can see it. All right. Give you a moment to do that. Whoa. Okay. Yeah, I can't see the screen. Thank you. Appreciate that. All right. So it looks like I'm checking in to see if I have any questions. Doesn't look like any. Okay. All right. So what I'd like you to do, you know what? Let's delete these. Just because we don't need them. Because we can calculate them. Those would not typically be given numbers. Okay. This one wouldn't be either. So let's go through the process. So we have a book value per share of $10. Book value per share of $10. The company on its book equity earns 25%. So what would its earnings be? Well, that's the product of these two, isn't it? So I can say equals $10 is earning 25%. And you know what? It's kind of prettier if you add another decimal there. Okay. Now we have the very bottom line of the income statement. It says that we have, well, once adjusted for shares, $2.50 per share. Okay. What happens to that $2.50? Well, this company's policy, at least next year, will be to pay out 20% of that as a dividend. So what's this payout percent? Well, relating that back, it's the complement to the plowback ratio. Remember, this earnings have only two homes. It's either paid out or plowed back. So if we're saying that we are paying out 20%, we must be plowing back 80%. Okay. So what's our dividend? It's going to pay out 20% of the 250. We'll pay out 50 cents. Therefore, what part of this 250 is reinvested in the company or is added to retained earnings? So we will add $2 to retained earnings. So here's the book value per share. This is all on a per share basis. So we were $10 per share. We'll be adding $2 per share to this $10 per share. So we go to the next year. We have $10 per share plus the $2 of year one's earnings that we will add to our book equity. Okay, and then the process just continues. So 250. So this time we're going to earn 25% on $12 of book equity. So we'll earn $3. Oops. And then again, we'll pay out 20% of that. So 60 cents. And then we will, how much of that will we retain? Well, that's why we did this. Why, do I need to calculate that again? No. All right. So I'll give you maybe a couple minutes and let you fill the rest of this table out. All right, well, I hope you're done with that. Let's just see how we do. This one I can do. So I'll just copy across. These two I can copy across. This one I'll copy across. This one I'll copy across. And these two. All right, now what is this telling me here? That I'm expecting this 16% ROE can be maintained into the foreseeable future, or we will use infinity to make it mathematically quite tight. So payout ratio, 50%, we're going to follow that to infinity also. Right. So far, so good. Let me check in. And nothing waiting for me. Sounds good. All right. Okay. Now we'll be valuing this stock. Okay. And let's work with some growth rates for a moment. So our biggest concern, of course, if you're the shareholder, what's your concern? What are the cash flows to me? Well, it's the dividends. So I'd like to know what's the growth rate in these dividends. Okay, well, you need 2 periods to do a growth rate, right? You can't just, one period doesn't mean anything. So let's go from year 1 to year 2. Okay, so if you said take the ending value, so it grew from 50 cents to 60, take the ending value, divide it by the beginning value, and subtract 1, you have a growth rate. Okay, and let's change that to a percent if we could. Now, the growth between years 2 and 3 is a bit meaningless, and that's for a couple of reasons. Here they are right here, this one and this one. You can see we're not maintaining a constant ROE or payout ratio. So we're kind of doing a regime shift here to a different way of running the company. Okay, so now you can see though, from 3 to 4, and from 3 to 4, our ROE and our payout ratio remain constant. So it would be reasonable to estimate a growth rate between years 3 and 4, and we can do that. And actually, if you just copy this cell right over here, you don't have to do it again. So it's 8%. So we have a growth rate of 8%, and we are assuming that this growth rate continues until infinity. All right, so let's do a couple of things here, just real quick. Okay, if I'm saying that this dividend will grow at 8%, what would it be for year 5? So let's estimate D5 very quickly. We don't need it for anything, but just to show you how the process works. So it should be dividend 4 times 1 plus the growth rate. Something you should learn if you're using Excel. Never type in something that you can reference. Okay, so I have this 8% right here, correct? So why would I type it in? I won't. I'll just do that. Okay, and I get $1.3436.93. I mean, okay, you would express this $1.34, wouldn't you? But I'm just trying to show you something. So I'm going to move these infinity signs over one space. Okay, and let's just continue our process for 1 more year. Okay, and so what would this 55.55 be, or 15.55 be next year? Well, it would be the 15.55 for year 4, and we decided to retain earnings. We're going to add $1.24 to that. Okay, so this 1680 will earn 16%. Actually, yeah. Let me just set that to 16%. That would give us earnings of 269. And we'll assume the payout remains at 50%. So paying out half of 269, we would see that the payout is $1.34, but is that what we got the other way? Yes, it is. So from $1.34, $36.93. So this is the growth rate of the dividend stream. Okay. Now there's another way to calculate the growth rate once you're in steady state. And the authors of your text provide this nifty little equation. If you just take the plowback ratio times the ROE. Okay, so for us, what would that be? Okay, we will be plowing back 50%. And our ROE from this point on is 16%. And so we should be growing at 8%. That's exactly what we got here, isn't it? So keep this one. We're going to use this several times. So keep this one somewhere in your space that where you have your recently used. Okay. So let's go back to the Word document. I just want to point something out. We are going to Excel and we're doing these things ourselves. That's just for our own edification, all right? The Word document has all the results in it right here. See that? So anything we do in Excel, I'll have it for you in this lecture note document. I'm just giving us a chance to do it live. That's the only thing I'm trying to accomplish. So someone asked me, would I be sending out my Excel files to you? Well, no, I don't, because the answers are all here, aren't they? Okay, so what you just did with that exercise, you created what's on page 89 of your text, table 4.4. So this, and except for a bit of rounding, it'll look exactly like what you see in table 4.4. Okay, so now that we have the earnings and dividends, we can value the GrowthTex company stock. Okay, first we need to estimate the continuous growth rate for the company. Okay, and we did that. So we're going to use 8%. Okay, so in our version of table 4.4, we show infinity signs for B and ROE. Thus, beginning in year 4, you'll have a constant growth rate of 8%. That continues indefinitely. So 50%. B and ROE. Oh, no. This is 16. So sorry. Looked right past that, didn't I? Forever. Okay. So here's the general model for a constant dividend growth valuation. You're going to say the price today is equal to the next dividend divided by the discount rate minus G. Okay, where D1 is the next expected dividend, R is the cost of equity capital, and G is the constant growth rate such that, now notice, what's the relationship between D1 and D2? It's a factor of 1 plus G. So D1 times 1 plus G is D2. D3 is D2 times 1 plus G. You can jump ahead a bit. D8 is D7 times 1 plus G. D10 is D9 times 1 plus G. Okay. Well, also there's a more general form of the basic model, not just the dividends. But the price in a given period is equal to the next dividend from that period divided by the quantity R minus G. So for example, according to the constant dividend growth model, the price in year 5 would be dividend 6 divided by R minus G. Okay. So there's always a 1 period lag between the dividend and the price, isn't there? All right. Now for us, we're moving into constant growth starting in year 4. Okay, so what does the shareholder receive who owns a share of this stock? 1 year from now, 50 cents. 2 years from now, 60 cents. 3 years from now, $1.15. 4 years, $1.24. 5 years, $1.34. And when does this end? It doesn't. Okay, it doesn't. So we have to do something to make this manageable. And what we do is we assume a constant growth beginning in our case, year 4. Okay, and so act as though, even though you're not doing it, act as though you sell it at the end of year 3. Okay, so what would the stock be worth at the end of year 3, according to this model? It would equal D4 divided by R minus G. So let's try this. P3 will equal 4 divided by R minus G. Okay. And so what is P3? So P3 is the present value of dividends 4, 5, 6, 7, 8, 9, 10 to infinity, valued at the end of year 3. Okay. So by being a shareholder today, you're entitled to D1, D2, D3, and all those other dividends out to infinity, but we can capture the value of dividends 4, 5, 6, 7 out to infinity as P3. Okay, so you're entitled to D1, D2, D3 plus P3, right? And so let's set up our cash flows. So we have our dividends. And you know what? Let me get a little more. Let's start out with our year. Okay. So we'll have years 1, 2, and 3. All right. And so we'll just take these dividends right from above. Okay. And then I'm also entitled to dividends 4, 5, 6, 7, 8, 9, 10, and so on out to infinity. I will capture those as this horizon value or continuing value, HV3. Okay, let's come out here. So, and we'll calculate this as what? We got it right here. D4 divided by R minus G. Okay, let's assume for this, what we're doing today, let's take an R of 10%. Okay, and our G is 8%. All right, so let's calculate HV3 equals D4, that's $1.24, divided by the quantity R minus G. Okay. So you basically have 2 stages in your evaluation process. You have individual dividends, and then you have a horizon value is stage 2. So stage 1, is discounting the individual dividends. And then stage 2 is discounting the continuing value or horizon value. Now, whether you use Excel or a financial calculator or a scientific calculator that has financial functions, you can only enter one cash flow per period. So I could discount this 62,208 separately from the $1.15 dividend if I wanted to, but why? So I'm going to add these together. And these are my totals, the total. And then any way you want to do it, copy it back or just set these equal. Anyway, okay, so now we're going to take the present value of 50 cents 1 year from now, 60 cents 2 years from now, 63.36 3 years from now, right? And so we will use price equal to the present value. Okay, we will employ the NPV function on Excel. And if you've worked with the NPV function before, you're probably disappointed in it, as most everybody is, in that it is not net present value. It is the present value of the following N cash flows. So the function says NPV. And if you notice the arguments, you're supposed to give it a rate. We can do that. Oops, what am I doing? Give it a rate, and we'll discount these cash flows at 10%. And then it asks you for your value 1, value 2, and so on. Okay, here now we highlight cash flows 1 through N. Now you might recall, if you're doing an NPV calculation, you actually start from cash flow 0, which you subtract, right? It's a negative number. Okay, this function does not do that. The first cash flow that you highlight, the NPV function will interpret that as cash flow 1. Okay, so we will then highlight these 3 cash flows. And there's our price. Okay, so this model says that the price today would be $48.55. Okay, let me just take a break. Will R be given? That depends on what we're actually studying. Yes, it will for these initial chapters, but we will be doing the net, or doing the capital budgeting process, which has numerous components, but of course would be the cost of the investment, the cash flows it generates, and then of course we will need a discount rate. So in those types of exercises, part of the process will be to estimate the cost of capital. So when we're just doing these first equity valuations, you'll either be given the R or a way to find it. Let me say that. Either given or a way to find it. And by that I mean that you'll either be given it outright, or that we can use the constant dividend growth rate model to back out what the implied discount rate would be. Okay, so we'll be doing that next class period for sure. But I would say that you'll either be given it or a way to find it. Does that answer the question? I hope so. Okay, let's continue. Okay, 48.55. Okay, let's go into the document again, see how we're following. Okay, you see this? So here's what traditionally this is what we're doing. This is what this NPV function just did for us. Except it didn't. You see why? Because I can only do one cash flow 3, so I combine. So this is actually what the NPV function did for us. Okay. Okay, and this is what we did. We got 48.55 pretty much. Okay. All right. What part of the 48.55 comes from the horizon value? All right. So if we're valuing this stock, what part of what we're calling the price by this model, 48.55, comes from this horizon value? So let's just calculate it. So we're going to say present value of HV3. Okay. Okay, so now do you understand that in order to arrive at this 48.55, we discounted the 62.208. That was part of the 63.36, wasn't it? And we've discounted this back 3 years to arrive at the 48.55. Okay, so a little bit different here. We will discount just the 62.208 back to a present value. So I'm going to say equals. I'll highlight this number and I'll divide it by 1.1. We'll just do it the traditional way. Raised to the third power. All right, so let's see how that comes out. All right, and then let's compare that to P0. And so what percent are we seeing here? So we're going to do PB8, HB3 divided by 0. And what do we get? And let's show that as a percent. All right, so 96% of the value which we estimated is due to our estimate of the horizon value. Now, why is that a big issue? Why are we even doing this? Let me show you a couple of things. What did we assume here for a growth rate? We assumed 8%, didn't we? What if that growth rate were actually 9? I just misestimated it. Okay, so I'm just going to enter a 9% here, if you don't mind. You don't have to do this, but at least follow what I'm doing. If I enter 9%, what kind of a price does that give me? Oh, look at that. 48 to 95, doubled. All right, let's go back to where we were. What happens if I overestimate it? It's really only 7. Oh, now it's 32. Okay, and so this is has a major role in determining the price, doesn't it? Okay. So how do we mitigate the effect of this our whole world depending upon whether or not you have good estimates of your horizon value? Well, if we go back to the Word document, I kind of explained that a little bit. Every so often, I get to teach the corporate valuation class, and in there, we do horizon values just like we're doing here. Not quite the same one that we're doing here, but we do horizon values. But what we do is we push them forward out to either year 10 or 15. You see, and then you assume that either after year 10 or after year 15, the constant growth begins. Right? So that horizon value has a much smaller impact on your price, and that's one way to mitigate the effect of having it so close. All right. So anyway, let's continue. Growth opportunity in that horizon value. While new companies can enjoy rapid growth initially, competitors often catch up and reduce growth. At the extreme, growth might cease completely. All right. What part of the company's horizon value is due to its growth opportunities beginning after year 3? All right, let's go back and see what we have. Okay, so we have so EPS 4, and we know that to be $1.24. Okay, we're paying out half of that. And you can get it from up above if you want. Wait, whoa, I got the wrong one. Let me see this. 249, my fault, thank you. Let's do that again. How do I pick a wrong cell? Okay, there we go. And $1.24 is the dividend, right? Now, what if this company, starting in year 4, cannot grow? Okay, so this is year 4. What happens if we go to year 5? Well, what if I said this equals 249? I can't grow. It's going nowhere. So this is year 5. And what happens to year 6? No growth. What happens to year 7? By the way, you know very well that if you attach a constant, you have a constant in one cell and an adjacent cell as an equation, Excel will automatically increment this for you, right? You've done that before? I'm sure you have. So year 7 and so on. These, anyway, I could take this out forever. So a no growth company, you have the same earnings every year. I can't grow. So what if you were managing this company and you have shareholders and you have to tell them, I cannot grow your book equity. It will not grow in this company. Okay, what should you be doing with the earnings then? Are you telling them you no longer have earnings? Oh, no, you have earnings. It's just those earnings are not growing. Okay? So if those earnings aren't growing, what should you be doing with them? Well, let's just make a blunt statement. Since you can't grow it, you give your shareholders an opportunity to find growth somewhere else. Okay? So the company still has value. It's just not as much value. So you pay it out. You pay out 100%. So we get a relationship here. EPS 4 becomes dividend 4. EPS 5 becomes dividend 5. So now we have a constant payout of 249. All right. Now go back to your basic model. And I suppose, do I have one here? Okay, I guess I don't. Let's go back to our basic model. P0. Or let's do our P3. We did the horizon value. Let's do that again. So P3 is equal to dividend 4 divided by R minus G. Okay? All right. So let's keep going and let's say G is 0. What do we get from this? This implies then that P3 will equal given 3, given 4, forgive me, divided by R minus 0. Okay, and we'll just save a step here. Or it means that EPS, EPS 4, forgive me, and dividend 4 are the same number now. We're paying out 100%. EPS 4 divided by R. Okay, and this is this would be the value of the company as a no growth at the end of year 3. Okay. So basically, now let's just do a couple of quick examples. What if I had a $10 cash stream that went forever? How would I value that? Well, if this goes on forever, just divide it by R. So plus this divided by, say, 10% is our R, you got $100. You see, so anytime you have a constant, not a constant growth, but a constant cash flow, its asymptotic value as it extends out to infinity. Now, obviously, we can't put our hands on an infinite value, but we can say that the series of constant cash flows as it goes to infinity approaches its asymptotic value, and in this case, it would be $100 for what I just did. Right? So just divide by R is all you have to do. So let's value Growth Tech without being a growth company. So let's do P3 equals 0 equals. So we're going to take the 249 and we will divide that by R. And our R is 10%, I believe it is. Okay, so there's two parts to the value. Just P3, on the other hand, has two parts. Plus the present value of the growth opportunities, PVGO, present value of its growth opportunities. You see, so these aren't the same, are they? Okay. So we know that P3, we did that. That's a 62 number. Let's go get it. $62.21. Excuse me. 62.21. Oops, let me look. Okay. Okay. So this 62.21 number has two parts to it. It's the values of no growth. That's this part.
Sorry, but we cannot see the screen right now.
You can't? Well, thank you for telling me that. I must have clicked on the wrong button. My fault. Thank you so much. All right, let's get it back. We need to share a screen. And I want to screen the desktop. Is that better?
Yes, thank you.
Yes, oh no, thank you. You're the star, not me. Okay, so if it were a growth company, its value at the end of year 3 would be 62,208. If it were a no growth company, its value at the end of year 3 would be 2488. So what is PVGO contributing to the value of this company? Well, you might say to yourself, it can't be that easy. Yes, it is. It's just the difference. Okay. So the growth opportunities at the end of year 3 have increased the value of this company by 3732. All right. So then our next question will be, well, what happens if the competition catches up and this company can no longer grow? Okay, so let's bring our dividend series back down again, where we can see it, just to recalculate a little bit here. So our dividend series is right here. Okay, those don't change. Okay, now our horizon value. Okay, we know that our horizon value was P3, and the way we initially valued this, we just put this in here, didn't we? Okay, now let's put up, this is a what if we're going to work with. What happens if it's no growth after year 3? Okay, well, what happens? That means that you can make an assumption here, not particularly bold one, that PVGO, so if you're not growing, what's the present value of your growth opportunities? I would say it's 0. Okay, now you remember this? This has 2 parts, doesn't it? So let me show you a little trick you can do. Oh, that didn't work. That's my fault. Okay, let me write these out. So that would be 2488. And this is 3732. They're close enough. Okay, so it's pretty close. Now, you know, and one of the little things you can do in Excel is that before your equal sign, just put a blank in there, and that changes the cell from a calculation to a literal. So see, now you can see how I got that. Well, what will be different if PVGO is 0? Well, you can see that this PVGO was 3732. When I readjust the price for no growth after year 3, then this 3732 basically disappears, doesn't it? Right? So we can just eliminate this part. Okay, so let's go back to here, and let's take out the 3732, and we know that it's 2488, don't we? So I'm going to say equals 2488, and we'll change this to, now that's plus 0, because that's gone. All right, and so the process from this point on is identical to what we've already done. I have the horizon value plus P3 as my cash flow 3, and these two cash flows remain exactly what they are. Okay, then I find the price, so this is our total, and this is the price. Will be the present value, so we'll do our favorite NPV again, and we'll use the 10% rate. If you want to enter 10%, that wouldn't be the worst thing the world's ever seen. And then we'll highlight the cash flows. And we get $20.51. Okay, so our first estimate of P0 was 48.55, wasn't it? 48. Let me find it. Where'd it go? Where'd it go? Here it is. Yeah, 48.55. You know what's changed? What's changed is that we are no longer receiving 37.32 3 years from now. This initially was what? 24.88 plus 37.32 for a total of 62.208, wasn't it? But if this company loses its growth opportunities after year 3, then this PVGO number goes to 0. Okay, so here's another way we could find this price. Rather than rather than going back and readjusting the horizon value, why don't I just take out the present value of PVGO3? Because I'm not receiving that anymore, correct? That's not part of the price any longer, is it? Because it's now 0. Okay, so if I said equals, and again, we want to be accurate here, so I know it's this 32 number right up here, 32 or 37, I'm sorry, 0.328, and I'm going to divide that by, and let's just do a simple discounting. So 1.1, and we will raise that to the third power. Okay, 1.1 to the third power. And that says our stock should be worth 28.04 less than it was initially. And so if I adjusted P0, then we'll take that 28.04 out of the price, and we get 20.51. It has to come out exactly the same, doesn't it? Right, I hope you're able to follow this, because I think it's question 23. I don't remember exactly. But what that question asks you to do is to go through everything we have done, except it wants you to use 12% as the discount rate instead of 10. So this should make your assignment much easier, just if you can follow this along. All right. Let's go back and see. Well, first of all, has everybody been able to keep up? I'm going to push the right button this time. Okay, looks good, looks good. How did you get to it? Yes, this is correct. Yes, EPS 4 over R. That is very correct. Let me switch back to that. That's right. Oh, what did I do wrong? I can't use EPS 4 unless I made a named variable out of it. So I go like that. There we go. Okay. All right, let's see what else is going on here. Make sure my screen is still shared. Yes, it is. And this was correct. How did you get dividend 4 above? I said the payout was 50%. And since the earnings were 249, I took 50% of 249. Does that answer the question? Okay, thank you. All right, very good. Anything else while we're pausing? Oops, sorry about that. I'm gonna give away somebody's personal information. Anything else I can answer while we're pausing? So we'll give everybody a chance to catch up. Okay, now again, I just remind you one more time that if you got any issues here, all these calculations are right here in the lecture notes. You see, so this is what the last thing we did. 2051. All right, let me make one last check. I thought I might have seen some. How did you get the price number? Which price are we talking about? The 2051? Yes, okay. We arrived at the 2051. We actually did it two ways. Okay, first of all, let's go back to how did we get 4855? Let's do that one first. Well, we had the horizon. If we understand the horizon value was 62,208, and then we later noted that that horizon value had two parts. It had the value as a no growth plus the 3732. And those both together equaled our original horizon value of 62.208, right? Okay, then we re-estimated the horizon value based on no growth, which meant that this PVGO went to zero. So I substitute zero for 3732. That gives me 2488, which we knew anyway. That was our P3 with no growth. I added dividend 3 and I discounted these three numbers and I got 2051. All right, the other way I did it was I took the 48. Let me do this one for you. It equals 3732 divided by 1.1 raised to the third. And that's pretty close. Okay, so what am I doing here? I have a cash flow of 3732, which I will no longer receive because that's the part of the cash flow representing the growth. Growth has gone to zero. So this 4855 number assumed a growth of 8% after year 3. Well, that growth is now zero. And so therefore I have to take out the PVGO from my horizon value. Okay, or I said what else I can do is just simply directly take the 3732, that's 3 years from now, so I'll make it a present value, and take it right out of the price, and I get exactly the same 2051 that I had once I made this adjustment. Okay, does that make sense, I hope? Okay. All right. That's good. I hope everybody's able to keep up. Again, I'll have my office hours starting on, if you had any trouble with this, starting on Wednesday from 1 to 3. And then I'll also have, as per syllabus, Monday office hours the following week. We have just one quick topic more for today, and I'm just going to introduce it. We won't work with it because I simply don't have time, but let me just show you what we have left here. I won't hide the file this time, I hope. All right, and that would be one of the, and that was a very relevant question as far as the discount rate earlier in the hour, and that is because discount rates are just simply not obvious items. When you try to estimate the cost of equity, well, you have If you're going to use for example, a CAPM, you have to have a market risk premium. Okay, and to get a market risk premium, you need a required rate of return on the markets. You have to estimate that first. Estimating the risk-free rate isn't all that difficult. Then you have to estimate the beta of the company. You got all kinds of things to do. It's not simple to find the cost of equity. Okay. Now, one approximation for a company's cost of equity is to simply flip the price earnings ratio. So if you take the price to earnings ratio and then flip it to become the earnings to price ratio, that would give you an estimate of the cost of equity. But is it a good estimate? So I want you to see the limitation of doing this kind of a thing. All right. And so let's come down here. We'll keep it kind of simple. We have a company that has $100 of equity. It has an ROE of 10% and a cost of capital of 10%. So ROE 10%, cash or equity of 100, therefore it generates cash flows of 10, 10, 10, 10, and we'll assume this goes out, it's a no growth, goes to infinity. All right. And then if we discount the cash flows, 10, divide that by 10%, we go right back to our 100. We're full circle, aren't we? Okay. Let's, instead of paying out this $10, let's reinvest it. Okay, so what does that change in the cash stream? Well, my shareholders were expecting $10 at the end of this year, $10 at next year, and so on. So next year, I return nothing to them. Why? Because I took the same $10 that they expect me to pay out, and I'm reinvesting it. So year two will have this $10 that we see in our original estimate. You'll have that $10 plus whatever this $10 that we reinvested in year one earns. Okay. And then that will happen again in year three, then again in year four. Okay, so let me just point out how the stream gets adjusted here. Okay, what if the company's ROE on the $10 investment? So say, we're normally 10% ROE, but for this investment we made in year one, we can only earn 5%. Okay, so cash flow one is still zero. We are reinvesting the $10 that we had expected to pay. Okay, so here is the original $10 that would have been paid in year two. And now we're going to earn 5 cents or 5%, forgive me, 5% on the $10 that we reinvested in year one. So that's 50 cents more. So now we're going to have a constant cash flow of 1050, 1050, and 1050. Okay, so what we'll be doing in class on Thursday, we will go through 3 different scenarios. And one will be this one, where we can only earn 5%. Scenario number 2 will be we can earn exactly 10%, our current ROE. And then the next scenario will be what happens if we earn above the ROE on this $10 investment? In other words, what if this is 15%? And we'll evaluate all 3 of those scenarios and try to demonstrate what is wrong with using the EP ratio as an estimate of the cost of equity. Okay, so we'll complete that, and then we have a few other things to do, and we'll hopefully be ready for your assignment for next Tuesday. All right, well, that's all I have. Check for any last questions, and then I think we'll sign off.